Welcome to Mark Arnold's Finance. I got a great video for you guys today. I'm going to be talking about the very popular REIT, Realty Income Corporation. This is a popular stock among dividend investors, and full transparency, I own this stock. It's in my portfolio, which I'm going to share with you in just a second. And so I thought it would be good for me to provide some bullish points, some bearish points, and at the end I'll tell you whether I think it's a buy, sell, or hold. So you don't want to miss this video. Now, with every single video on this channel, I share my portfolio performance. So if you like that type of transparency, be sure to subscribe, join me on this journey. In fact, the people that are subscribed, I'm considering my YouTube family, and we're all gonna grow together, right? We're gonna share our knowledge, we're gonna share our failures, our ups and our downs, so we can grow and become wealthy long term. I provide diverse content, so I think it's just a great channel. Be sure to give it a shot. I'd really appreciate it, and thank you to all those who are subscribed. So let's get right into the transparency and look at my portfolio performance. And it's not looking good. I am down over 10% now. That is $4,600 of unrealized loss. I want to turn your attention now down to real estate. There's my holding, Realty Income Corporation, ticker symbol O. It is down 2.35% in my portfolio. Anything in purple is the allocation by market value. So you'll see here, it's a decent holding of mine. And this is a stock that I'd love to add to. I do think it's a quality company, but I do think there are some good points that I'm going to be bringing up both on the bullish and bearish side for you to consider. Now, also, you'll notice that this looks a little different. This whole portfolio, I moved the healthcare up to the top, and on the bottom right corner, you'll see a very lonely empty space. That's because I've made a change. I sold out of one of my holdings. I sold out of DuPont. Yes, this was a specialty chemicals company, and it was in the material sector. And for me, I got into this company for the wrong reason. I just did a video on my biggest failures, and one of the points I made is that sometimes people, especially new investors, listen to others without doing any research. And so I listened to someone else and I just went off of their word and I bought into this company, but I sold out for a few reasons. One, it was only $300 of me investing into it. I only put $300 into this company. So I thought it's such a small holding, it's not going to really do anything for me, whether it goes in the green or the red. And also, secondly, I do a metrics chart. If you're follow my channel, you'll be familiar with this. I filled out this metrics chart for DuPont, and I saw a lot of negative. So anything in red is me comparing it to the industry average, and anything that's highly in the negative, so big deviation in the negative, I would highlight red. So compared to its peers, for example, DD has high PE ratio. They have low EPS growth. They have low revenue growth, low cash flow, low return on equity. These are all big negatives for me. So I thought, why am I holding this? I only have 300 bucks in it. It doesn't look good. So I decided to sell out. And instead, I deployed my cash of DD to buy a share of Microsoft and a share of Cisco. So that's one of the changes to my portfolio, but let's get into this video. I want to talk about Realty Income. I think this is a fascinating company. So Realty Income is a REIT. It acquires and manages freestanding single client commercial properties that generate rental revenue under long-term net lease agreements, typically longer than 10 years. They also have over 11,400 commercial properties under those long-term net lease agreements. They have 98.9% portfolio occupancy, which is awesome. They have over 1,100 different clients and 72 separate industries that they're in. So this company, I do like this company. Some points I'm going to bring up, though, are keeping me on the fence with it, just to give you a little heads up. But that still doesn't mean I can't say it's a buy, a sell, or a hold. So be sure to stay till the end. I want to go straight into the bullish thesis, right? Let's get the good news over with first, and then we'll go into the bearish side of things. So the first thing I'd like to point out is that this company is not highly leveraged. This is awesome, which means it has low debt, and that is going to allow it to make acquisitions, and that's exactly what it's doing. And we'll see here in a minute just how much acquisitions it's making every quarter. So right now, with the high interest rates, it's priced out a lot of the high leverage competitors, which is awesome. So they're getting in there and they're acquiring things. But I want to show you their debt in kind of a different light. So you'll see here there's a lot of different ratios on the very left. Realty Income is in the next column. Then the industry averages are in the next column. And then the percentile of O compared to the industry averages are in the last column. And I drew a yellow line down showing that it's very low in all of its debt ratings, ratios, measurements, whatever you want to call them, and that is fantastic. That is a very healthy thing to see, and I love seeing that. So their acquisitions, shall I say their acquisition spend is increasing quarter over quarter. So in quarter one, they spent 1.5 billion in acquisitions. Quarter two, they spent 1.7 billion. And quarter three, they spent 1.8 billion. So they're increasing their acquisition spend, which they should be doing. They should be taking advantage of these times with them being a low leverage company. So I love that about them. That's something I'm very bullish on with Realty Income. The next bullish point is that they have a very strong balance sheet. We will see here that they have low liabilities compared to assets. They have a 41.3% liability to asset ratio, which with their low debt, their healthy balance sheet, so far it's looking really good. And currently they are only one of 7 S&P 500 REITs with 2 A3 to A- ratings, meaning that they are less likely to default on their debt. And when they're looking to do business, other companies are going to be more likely to do business with them rather than any other company, because that is low risk. And that is just a great thing when you're out there trying to make deals and so on and so forth. So that's awesome. That's probably why they're able to acquire so much and increase that spend, because they have the backing of their ratings. So I think that's fantastic. The next bullish point I'm going to make is that they have good holdings, good diversification of their own portfolio of the properties that they hold. So they hold non-discretionary and low ticket price retail entities who remain relatively insulated from recessionary pressures. So I want to show you 2 snips here. The first one is the top 10 industries they're in. Now I highlighted the top 5 because I feel these are low risk, right? These are ones that are going to be those low ticket price retailers that are non-discretionary and are insulated from those recession pressures. And those are grocery stores, convenience stores, dollar stores, quick service restaurants, and drug stores. Now the ones that won't do too well, let's say people want to cut back on their spending, are the casual dining restaurants, health and fitness, and maybe automotive services. So the fact that the top 5 make up most of their allocation and they're low risk, in my opinion, is a great thing. Now, if we move to the individual clients, these are their top 20 clients. We'll see here their top 4 I consider low risk, and that's anything highlighted in green. So we have Walgreens, Dollar General, 7-Eleven, and Dollar Tree. There's also CVS Pharmacy, Walmart Sam Club, Tractor Supply, Home Depot, and Kroger that I consider more low risk. And now the higher risk ones are FedEx, LA Fitness, BJ's, AMC Theaters, Red Lobster, Regal Cinemas, Lifetime Fitness. These are areas where people will more likely cut their spending should they fall in hard times, where the ones in green are the ones that people are going to be most likely be repeat customers because they need these things instead of want. So I do like the allocation as well here. So I think they have a very strong holding of their clientele, and that's fantastic. The last point I want to bring up on the bullish side of things is they're looking oversold and they're nearing a buying range. I read a Seeking Alpha article and I found this chart, and we'll see here that Realty Income is getting near what's called a congestion zone. This is a zone where Realty Income kind of takes a turn and starts going back up. So the dollar value per share is on the right. We saw it got up to about $73 to $74 per share. Now it's back down to $57 per share, and it's entering in that bottom half of this yellow section, which is the congestion zone, which means we could be seeing a turning around point, because now it's being oversold and it's nearing that buying range. So this is something, take with a grain of salt. It's a chart, but I think it's still good to see these things because it helps you also determine, okay, I think it's getting into a good range based on all my other research I did, but also this chart is kind of backing that up for me. So there's my bullish points on Realty Income. Now I want to move into the bearish points. So we'll start with their slowing AFFO growth this year. Now what's AFFO? It's not a band. It's not some type of DJ. It's adjusted funds from operations. And this term refers to computation made by analysts and investors to measure a real estate company's reoccurring normalized funds from operations after deducting capital improvement funding. And this is how you measure the REITs. And so the only negative here with Their AFFO is it's downtrending. We will see in quarter one, they had 14% growth in AFFO. In quarter two, it fell to 10% growth. And they're expecting that to keep going down and could go as low as 6%. Now, with any company that you invest in, you want to see growing profits, revenue, AFFO, and the fact that this is decline is kind of a negative. But I do think it should turn around at some point, but not in the near term because the environment and the economy is continuing to be in a worsening state. And so with this happening with Realty Income, it's just one of the bearish things that I wanted to mention. Now, the next bearish thing is Realty Income's forward valuations don't look too enticing compared to their peers. So the one thing we want to look at is their forward price to AFFO basis. And O currently trades at a 10% premium to its peers. So we will see here that it's near the high end range of its peers. So it's at a 15.44 where the average is 14.04. And you'll see the other companies that it kind of competes with, Store Capital, Spirit Realty, Agree Realty is the only one that's above, but it's near the high end range with its forward price to AFFO. And so that's not attractive, right? If you want to buy at a good valuation. So that's something to consider. Now, the last kind of bearish point that I can kind of think of, I don't think this is necessarily a huge negative, but their dividend is towards the low end compared to its peers. Right now, it's paying a 5.13% dividend. Compared to the risk-free 10-year treasury, which is at about a 3.76, it's nearing a 4 probably at this point, now that I'm speaking, because this data was a few weeks ago. Why not take a risk-free route where with O, it could keep declining in value? And also compared to its peers, let's take a look at its dividend. We will see here that it is towards the low range. So I know this is small, but I highlighted in yellow. It's the purple line at the bottom, and there's only one other peer below it, but it is towards the low end of their dividend payout compared to its peers. And as a dividend, kind of popular stock, it is in the name, Realty Income Corporation, that word income. So that's something that I think is something you should consider because it should be stronger compared to its peers, in my opinion, especially for the way they tout themselves as the monthly dividend payer. I really think that they should be more attractive than where they're at. So now let's look at my view, my opinion on this company. So they have low debt. To me, that is one of the best things I can look for in a company. I love when companies have low debt because they can pivot easier, right? They're acquiring at higher and higher rates, and they're able to do that because of their low debt. So that's awesome, and that's going to position them to be stronger in the future. So like I said, they're acquiring and they should be taking advantage, and they are. So that's great. They do have a strong balance sheet. So financially, that's just more positive for us investors. And I like their holdings in their portfolio, right? It should hold up well overall, regardless if we go into a deep recession or not. Now, the negatives are they have the slowing AFFO growth. They have dividend that could be more attractive. So when I weigh things, I think I'm more on the bullish side because mainly of that low debt that is very attractive to me. So right now, let's look at the metrics of O. I'm going to bring this up here. There we go. So with O, if we look at the metrics, right now its PE ratio is at a 54.75. Its 5-year average is at a 54.43. So it's actually higher than its 5-year average. If we look at some other points, its EPS compared to the industry, it's kind of suffering, but its revenue growth has been good. Its cash flow growth is on the low end, but you got to keep in mind with cash flow, that's the money that's going in and out. But if they're doing all this acquiring, that's probably why it's lower than its peers. So this could not be a negative, it could be a positive. The return on equity is low, and they are diluting shareholders because their shares outstanding are going up. So looking at that and considering that I'm more bullish based on the points that I made compared to the bearish, I think the bearish points are something to consider, but the weight that I give to the bearish and bullish is that low leverage. I give high weight to that. They have low debt. We looked at that chart, and overall, every metric, it's low compared to its peers. So for that reason, I think I would like to see it below its 5-year average. So where I would buy into this company, where I think it would be a good buying in point, would be at a 50 PE ratio, which means I'd be buying at $53 per share or below. Right now it's at $57.35, and I'd be buying at $53 or below. Now, analysts rate this price target, this company, shall I say, between $68 and $80 a share. So it is undervalued compared to analysts, but I want to add a level of safety, right? So I think $53 and below is my buying in point. So right now, I rate it a hold, but it's getting very close to my buy point. What I'd like to hear from you guys now is, do you think Realty Income is a good quality company? Do you think currently it's a buy, sell, or hold? And do you agree with my price point to be buying in below $53, or should I say at or below $53 a share? I would like to hear your opinion. I know this is a very popular stock, so I think that there's probably a range of averages in people's portfolios. Again, I'm down a little over 2%, so I'd love to average down, but I would like to see it go down to that 50 PE ratio, which means it needs to go down about $5 more per share, and then I'd be buying in. I would definitely be adding at that point. So with that said, I think Realty Income's a great quality company. I think it does have a good future. It has some pain points right now, but I think those will turn around. I would like to see a more attractive dividend. It is a monthly pair, which is pretty awesome to see those dividends roll in every single month. So with that said, let me know your thoughts. I really appreciate you guys joining me today. Again, if you appreciate the transparency, be sure to subscribe, join me on this journey. And with that said, I hope you guys have a great day, and we'll see you next time on Mark Arnold's Finance.